Welcome back to Prophetic Insights. Today we're going to look at the collapse of SVB, Silicon Valley Bank, as well as the New York Signature Bank. And I want to discuss a couple of things as we examine that, because there's a lot of question and discussion, innuendo, suspicion, conspiracy, as to this possibly being a prelude to the end of the US banking system or the financial system. So I think it's important that we look at three things. One, let's examine what happened to SVB. Two, well, let's examine what will happen in the future as we look at the landscape, what the future holds. And then three, let's look at a biblical perspective. What does the Bible say in reference to our finances and the end of the world? So let's jump in. Number one, how did SVB get into this fiasco in the first place? How did the nation's 16th largest bank collapse in what seemed like just a matter of days? It's important to grasp one simple concept, that banks are in business to make money. Like any other business, they open their doors to make money. And they don't keep money, or they don't make money by having money on hand. Their money is made from receiving it from their customers and then turning around and being able to invest that money or to lend that money out. So in a simple analogy, think of it as this. You have $1,000 and you go to the bank and you invest it in a savings account. That savings account may earn 1%, 2%, or 3% interest. You put it there, whether it's a savings account or you can say a CD for that matter. Let's assume it's a savings account or CD. You put that $1,000 in. The bank then recognizes that you won't come back in the next day and withdraw that $1,000, that you're going to place it there for a period of time so that you can grow that money. So they take that $1,000 that you've given them, and maybe they promise you a 3% payout. So at the end of the year, they're going to give you 3% on $1,000. That same $1,000 they'll take and then lend it to someone else. And so your next door neighbor goes into the same branch or a different branch, and they want to buy a car. They don't have all the money to buy a car, but they have some of the money and they need to borrow the rest. And let's just say, to keep it simple, that they perhaps need to borrow $1,000 from the bank. So the bank would write them a loan, and the loan that they may write may be for 10% interest that they're going to pay for that $1,000 that they borrow. So the bank took the $1,000 from you and gives $1,000 to your neighbor. They promise you that they'll give you 3% interest, and they tell the neighbor to pay them 10% interest. So in quick math, that means that the neighbor is going to pay them back $1,000, and they've promised to pay you $300. So a spread between the money that they are promising you of 3% and the money that they're going to get back in from, or that they're charging the lender 10%, that's a 7% spread. That's just keeping it very rudimentary, very basic. So the bank then will make 7% off of the money that you gave them. And as long as they can continue to do that, that makes money for them, as assuming that they're making more good loans than they are bad loans and other series of factors, but that's just keeping it very elementary. The second thing to consider is that banks don't keep that money on hand. The average bank may have $20,000 in its vault. So if there are people in the local community that have invested hundreds of thousands of dollars in the bank doesn't have that money just sitting there in a vault. Contrary to a lot of the movies that we've seen and the ideas that we've grown up in our childhood and infancy, banks don't have hundreds of thousands and millions of dollars on hand. There are some that, of course, would have millions, just depending upon the volume, but typically speaking, the average bank is about $20,000. So what happens then when people need money? Well, assuming then that maybe $700,000 has been invested in that community. If all of the bank's customers went to withdraw $700,000 on any day, the bank does not have the money to be able to accommodate that type of withdrawal. Think of it this way. Disneyland, known as the world's happiest place on earth, has over 1 million annual pass holders. How can Disney have over 1 million pass holders that have access to come to the theme park any day of the year? What would happen if everyone decided that they wanted to show up to Disney on one day? Well, obviously, 1 million people showing up to a theme park, they would not be able to get in. You simply don't have the room to be able to accommodate. So how is Disney able to sell so many annual pass holders year after year after year and not run into a problem? It's simple. Everyone doesn't show up on the same day. Some show up on Monday, June the 1st. Some show up on Thursday, June the 15th. Some show up on December the 10th. You get the idea. Throughout the course of the year, if they can handle the volume of traffic, just as long as everyone doesn't show up on the same day trying to gain access. In the same way, a bank has that money every day that they can take in, they can pay out. But if everyone came at one time, then that will create a strain on that bank, or in general terms, what we'll call will be a bank run, because the bank simply would not have the money to be able to pay out. And you know what happened at that point? People would come in, and if you're trying to withdraw your money, and assuming that they had the $20,000 in there, and they've reached that $20,000 limit, and you went in to withdraw some money out, whether it's $15 or $15,000, and the bank said, we don't have the money, come back tomorrow, you're instantly going to get on the phone or open your cell phone, text someone and say, hey, better get down here because I just came down and I couldn't get my money out of the bank. And that person that you've reached out to is going to reach out to someone else and say, hey, you better get down there because Joe just went and couldn't get their money. I'm going to get my money out. And that frenzy builds up. And before you know it, you have hundreds of people trying to get access to the bank, and the word will spread. And not only puts a drain on that bank, but it will ripple over, or could potentially ripple over, to other banks as well. Similar to what we saw in the toilet paper and toilet tissue issues that we had during COVID. People hoarded, they grabbed because there was a fear of it not being there in the future. This is what happens on the back end of a bank run. But how did SVB get here in the first place? As the bank continued to grow, some of the investments that they did, in addition to lending, is that they invested in the bond market. And again, a bank's role is to make a profit, as any other business is. They invested in the bond market when rates were near zero. Now, what we know over the last couple of years is that interest rates have gone up due to inflation. Part of what the Fed has done is they tried to stymie inflation. And how did they do that? Is that they wanted they raise interest rates. Now, there is an inverse relationship between the bond market and between interest rates. When one goes up, the other goes down. When one goes down, the other one goes up. It's an inverse relationship. So as the interest rates rose, then bonds continued to go further down. In order to raise money, SVB had to sell some of those investments that they had made in the bond market. The problem was the bond market had gone down. It's like buying a house and the rate has dipped on the house. And now, due to something unforeseen, you have to sell the house and you're underwater. So in short, SVB was underwater in some of their investments. Now, as that had took place, investors who looked at the strength of the company in terms of the stock market then recognized that they didn't want to have their shares in SVB because this might not be a good, this would probably not be as good a growth as what they had anticipated. So they began to pull their shares. This puts a lot of downward pressure on the bank. It'd be the same as Apple announcing that it's going to sell 15 million iPhones over the next 2 years. But out of nowhere, they have a problem with a semiconductor. There's a problem somewhere in the supply chain. And Apple is no longer able to sell those 15 million iPhones. So investors now become skittish and they say, well, before this was a good investment. If I put in $100, I was going to make money. But now you're not going to be able to deliver your product. So I want to sell those shares and maybe go invest in Microsoft or go invest in Google or some other competitor. That puts downward pressure on the market because, again, that is how companies raise additional capital. So as that took place and shareholders begin to sell, this creates additional pressure on SVB to shore up their balance sheet because they need to have a certain amount of assets to be able to conduct business. Now, simultaneously as this is taking place, SVB had a different issue that was happening. In that they primarily cater to venture capitalists, many VCs began to pull their money just because of various investments and such that they were doing, that people needed their money. But we've already identified that most banks simply don't have that money on term, that they may take a short-term loan from another bank. They may take a loan from the central bank, et cetera, but they don't have that money on hand depending upon what the severity or the need is. So as VCs or their customers begin to pool money to be able to use in other things or to just hold it so that they would have in their reserves for other projects and purposes that they had, that put a strain on SVB's finances. In the midst of this perfect storm that is brewing, customers start pulling out additional funds from SVB. And when they were not able to gain access to their cash, this caused a crisis. So the Fed looking over the situation. And so federal regulators then stepped in and took over the operations of the bank. And they did something unprecedented. They stated that they would make sure that those who were bank customers would be sure of their deposits. Now, traditionally, the FDIC insurance insured customers up to like $100,000. This was going back maybe 15 years ago. After the financial crisis, the housing crisis in 2007, 2008, the FDIC raised its insurance limits up to $250,000 per account per customer. So this meant then that if you had $250,000 invested, not invested, but if you had $250,000 at any bank, SVB, Bank of America, Wells Fargo, et cetera, that up to $250,000, that's safe. So in short, if you had $1 million, then anything above the $250,000 would then possibly be lost. That was not insured. So if you had a home that was worth $1 million, but you only had insurance on it for $100,000, if the home burns to the ground, you're only insured for the first $100,000. You're out of the $900,000. Now, think of all of this pressure that this created or will create in the market, that people were wondering, what happens then? What about companies that have more than $250,000? What about companies that have hundreds of thousands of dollars or millions of dollars in those accounts? How will they be able to get access to it? What's going to happen to them? This will turn the market on its head. So the FDIC, in conjunction and collaboration with the president, the Treasury, did something unusual. They said that we're going to make sure that all depositors are made whole. Why is that? Because they needed to make sure that stability was seen throughout the market. If SVB were to collapse and people had money north of $250,000 and were unable to retrieve that money, or bank customers, business customers were unable to get that money, then what would you have happen? You would have a natural run on the market. People would pull money out of the banking institutions, anything north of 250, because they feel, hey, I can't have it there. And you could only create so many various accounts at different enterprises at different banks before one would get tired. It will create a strain. It will create a financial calamity. So this is what happened to SVB. And fortunately, the FDIC was willing to back and guarantee to make sure that those depositors were made whole. And again, that insurance, the FDIC, that's insurance, of course, that banks pay to be a part of the program. So fortunately, they were made whole. Signature Bank, on the other hand, had a different experience. They were heavily invested in the crypto market. And if you've looked at anything in the crypto market, you know that that has gone north and then it's gone south, it's gone sideways and gone more south than north. Similar situation, similar problem there that shareholders took part in. Now, with both of those, and particularly with SVB in general, the president and others have stated that investors would not be made whole. That if they were unable to, from the sale of liquidation of assets, et cetera, if there was a loss, the loss would be borne by investors, not people who were regular bank customers. And there's a sharp and clear distinction between the two. So now that we've looked at that, of what happened with SVB, what does the future hold? Is this the harbinger of other disasters? For those who jump on the newest thing that pops in the news, you will be overly concerned, overly anxious. But I want to reassure you in a few aspects today. First, the collapse of SVB is not the first bank that has collapsed. And you can bet your bottom dollar, it will not be the last bank that collapses. In fact, that from 2001 to 2022, that there were over 550 banks that collapsed. Let me repeat that again. From 2001 to 2022, that there were over 550 banks that collapsed. The height of that was during the Great Recession. 2008, there were 25 banks collapsed, 2009, 140, 2010, 157, and then 2011, 92. So what does this tell us about history? Well, let's just know that banks will come and go. that various ones will do well and some will collapse, that we would expect this to take place in terms of the market. Now, the Bible tells us in the book of Ecclesiastes that there is no new thing under the sun. We see like a repetition in cycles of events of transpiring and unfolding. This is a similar event that we see also transpiring and unfolding. We know then that the US banking system is not going anywhere. The issue that took place there, these are outliers that we look at, not a systemic of a problem of a global failure that we're looking at or anticipating. And that's helpful to know. In fact, more so than helpful to know, we can rest assured on that because we don't have to worry about what will take place in the future. The Bible lets us know clearly in the book of Revelation and in James and other places that money will still have its value. There's some people who anticipate at the end of the time that money will have no value, that people will not have dollars, that the economy of America will collapse, that the global economy of the world will collapse. Now that runs contrary to what we read in the scriptures. The Bible says in the book of Revelation, chapter 13, that no man is able to buy or sell unless he has the mark of the beast or the number of his name. By the fact that a person is not able to buy and sell, it infers that if they receive the mark, that they would be able to buy and sell. Please note that it does not talk of bartering, but it is simply dealing with the issue of buying and selling, purchasing, procuring goods and services, traditional market of buying and selling. When we look throughout history, we know that there have been different commodities that people have placed value in. The Romans traded in salt. That was used as payment in short. And so we use the expression that they're not worth their salt. People would trade animals. People would barter services. These are different things. When we look at collapses of micro collapses in economies and so forth, we find that people go to a system of bartering. Think of prisons. People would get cigarettes and they'll barter, they'll trade, they'll sell. Today, people on the black market will barter and trade and sell various things. And it is not tied into cash necessarily. These are things that are tied into services. So the Bible lets us know then at the end, though, that there's going to be an issue regarding buying and selling. It doesn't tell us there's an issue regarding the economy, but it's an issue over buying and selling. So you have no fear then of the economy. The fear that is brought at the end, the issue that is at the end, is that will men receive a mark so that they may be able to continue to buy or sell, or will they stand fast in their allegiance to God? Revelation chapter 18 talks of the merchants of the earth wailing because of the great doom that has come upon Babylon, that they're unable to sell their wares anymore. Again, there's the emphasis there. Why are they unable to sell? Because the judgments of God are coming down. The Bible lets us know that instead of seeking to build up and to worry about silver and gold, not that it's not important that we have resources and that we're able to have assets and to accumulate, but there are warnings that the scripture tells us. It tells us that if we are seeking to be rich and that becomes like our overwhelming desire, then we need to watch ourselves. Because somewhere along the line, if the only consuming desire is to make a quick buck, then we will possibly do things to sell our souls short. We'll do things to compromise our beliefs. We'll do things to sully the water because we're trying to make a quick dollar. And so it says then that those that would hasten to be rich will fall into snares because the love of money is the root of all evil. We also read in the book of Proverbs that a person that hasteth to be rich is going to pay for it. There's nothing wrong with assets, but we must make sure that assets don't have control of us. So in the time period of this world, when there is some uncertainty that people have, we may have absolute certainty and assurance that comes from God and through his word. So we see banks come and go, then we know that God is still in control of affairs, that these will be things that will take place. They may be a little unsettling, but as our silver and gold is not laid upon earth, but we've built up and laid into the heavens above, we will have confidence and utmost assurance that God will be with us and keep us and let us have even perfect peace in these times. But if we made this earth our home, and this is all we have to look forward to, then absolutely, we're going to be terrified when we hear of banks collapsing. We're going to be terrified when we see changes in the market. It will cause us to be concerned because we have invested and put our all here. But when we lay up treasures above, where thief does not break through, nor moth rust and corrupt, then we need not worry As always, thank you for tuning in and joining. If you have any questions or comments, please be sure to leave them in the box below and I will answer them. So until next time, may God bless you and keep you.